drop in bad debts. This is what also helped boost your profit numbers, and we're talking about a 9% increase in annual profits and literally beating expectations.
Yeah, thank you. I think we were a touch ahead of expectations. When we put out our third quarter trading statement, we said that diluted headline earnings per share would be up somewhere between 0 and 8%. They came in at 8.7, so I guess that's where your 9% came from. So a touch ahead of expectations. Bad debts did decrease, as you said, but with the credit loss ratio at 1.36%, it's still, significantly above our target range for that number, which is between 60 and 100 basis points. So there's still a way to go before our bad debts are more normalized.
So you're talking about a 30% drop coming through on the credit loss ratio front. And just looking at bad debt costs, they came to 6.2 billion rand versus the 6.6 billion in the previous year. You saw quite a nice recovery coming to the fore there. You're talking about dropping that level by a further 30%. What do you plan to do going forward? And tell us about some of the strategies that you implemented to see this drop in bad debts.
Yeah, sure. So some of it is economic. Clearly, the significant drop in interest rates have made installments much more affordable for the South African consumer. Household debt levels still remain high.
At 78%.
At 78%, but the affordability of installments is significantly enhanced as interest rates have come down. We also put a significant amount of effort into our collections environment, particularly in the retail businesses in the second half of last year. So our outlook as we look forward into 2011 is we'd expect that 1.36 to continue to drop, but probably remain just above the top of our target range of 1%.
It's quite interesting because you're talking about the momentum going forward and the fact that you can sustain that momentum. Some of the view that we could see an interest rate hike later on this year in South Africa. We've got inflation pressures coming through as well. How are you factoring all those issues into your numbers?
Yeah, so certainly, we currently expect that the economy in 2011 will be better than 10, as 10 was better than 9. Our current outlook for interest rates is that they will remain flat for 2011, which interestingly enough helps us because we get less pressure on endowment. As interest rates cut, we get some short-term pain in endowment for longer-term gain in improved bad debts. So we're expecting rates to remain flat, although I'm sure by the time we get to the second half of this year, inflation is likely to tick up, so there could be some pressure for rates to hike either in Q4 or in Q1 of 12.
Quite interesting to note what we're seeing through coming in Europe. We've got markets coming under pressure. HSBC said it's cut its profitability target because of the cost of implementing the new banking regulations and capital requirements. We've also heard word on this in your results. Your final dividend of 268 cents a share, the total dividend for the year to 442 cents. It's down from the year before, but you say that you've adopted a conservative dividend approach because of the tougher new capital requirements going forward. Do you think this is going to be a trend not only in South Africa but also coming through in Europe and the developed markets as well?
Yeah, so I think your data is slightly incorrect. Our dividend was in fact up year on year by 9.1%. We kept our dividend cover ratio flat. So the full year H1 and H2 dividend was R4.80, R2.12 in the first half, R2.68 in the second half. So we've certainly kept our dividend cover ratios flat. And we have been able to grow our capital levels with core tier 1 sitting at 10.1%.
So, I mean, just looking at the capital requirements, are you still talking about tougher regulations? Are you concerned about that? Do you think you'll be able to slide into the new regulatory environment?
Yeah, so certainly from, there are two big pieces of the new regulatory environment, capital and liquidity. Certainly we think for all South African banks, the capital requirements of Basel III are eminently doable. So there's no challenges really around that. I think the liquidity requirements as currently drafted would be problematic for all emerging markets and South Africa as well.
Let's touch on a story last year where many were focusing on this. HSBC abandoned the bid to buy a $7.3 billion controlling stake in the bank. In hindsight, what are your sentiments? Are you concerned about things going forward? Are you disappointed the deal didn't go through? Or are you sitting in a position where you are starting to see things recovering, particularly coming through on your retail sector?
So certainly in the first instance, looking at these numbers, we think they missed a great opportunity. From our perspective, we very much focused on business as usual. We said that we thought having a global banking parent instead of an insurance parent could help accelerate the delivery of our strategy, but that we're very comfortable that the base case delivery of our strategy will still provide good value to shareholders. So we're very comfortable in the current environment.
Well, market talk that Nedbank may be still up for sale. Have you received any offers of late?
So certainly we wouldn't receive the offers. Old Mutual would receive the offers.
Have you received any phone calls, Mike?
Certainly we aren't in discussions or having phone calls with anyone. I think what Old Mutual's very consistently said, though, is that they're very happy to own half of Nedbank. It's a great investment for them. But if they found an owner who could add more value to the business than they could, then they would possibly enter into discussions, but there's certainly nothing on the table.
Mike, also, I mean, the fact that we've seen a nice recovery coming through on your balance sheet, particularly as I mentioned in your retail division, do you think that this is setting you up in a far better position than where you were before, where the deal actually came through from HSBC?
Yeah, so certainly we think that the outlook for growth is better. As we sit here today, you'll see that our retail business went from making a loss to making a profit. So there has been a strong turnaround in their earnings generating capacity. The retail business is, however, still producing only a 5% return on equity. So there's still quite a long way to go to get up to our cost of equity of around 14%. But we're much more confident sitting here today about our earnings outlook for 2011 than we would have been a year ago about our earnings outlook for 2010.
Mike, you're also delving into the lower end of the market. We've seen some models coming to the fore that is actually assisting your business as well. Tell us a little bit about your strategy going forward, and also perhaps Africa as well, because it has been one of the sectors that you haven't really delved into. Are you planning to have more of a focus on that going forward?
Yeah, so we've had quite a strong focus into the mass market for a number of years now. We've been running a very successful personal loans business for over 10 years. And if you look into the numbers, that business did very well for us this year again. We're probably a number 2 market share player in the personal loans business at the moment. We've continued to roll out a significant amount of infrastructure. So albeit that our costs on a like-for-like basis were only up 8.5%, during the course of 2010, we opened more than 17 new branches, added 400 ATMs, about 70 or 80 personal loans branches. So we have continued to focus on growing our distribution footprint. If I look at Africa, essentially we have a vision to build Africa's most admired bank. To be Africa's most admired bank, you have to, given where the economic profit pools fall, be South Africa's most admired bank. So we have a lot of work to do still domestically, and we think that still gives us a lot of growth opportunities. But over the longer term, we continue to look for inorganic opportunities in Africa that meet financial, strategic and cultural hurdles.
Acquisitions,
that's correct.
Are you looking at any Nigerian banks at this point?
No, we aren't. So there's nothing on the table as we sit here talking.